Today we're looking at an investment analysis, a very comprehensive and highly bullish strong buy thesis for BlackRock.
Yeah, it's driven by some elite financial metrics and what looks like a favorable technical setup. The quantitative work here is, I have to say, pretty phenomenal.
It really is. It establishes that financial fortress idea and a potential 40% upside, which is huge.
For sure. The foundation is impressive. You've got the 26.6% profit margin, that massive $4.7 billion in free cash flow, and a super defensive debt-to-equity ratio.
An undeniable case for quality, really. So now the goal is, how do we take that conviction and build a narrative that can withstand, the highest level of scrutiny?
Exactly. How do we maximize the analytical impact?
I think that's the key. We're focusing on adding those layers of analytical robustness that turn a strong opinion into an unassailable conclusion.
Okay, so where do we start?
The persuasive power of this strong buy thesis would be dramatically amplified by proactively incorporating the primary risks and counterarguments inherent in this investment.
Acknowledging the other side.
Right. Right now, the analysis leans very heavily on that flight to quality narrative and those stellar metrics we mentioned.
Which are great, but
it entirely omits any discussion of potential material weaknesses, headwinds, and for an expert reader, seeing a pure bull case without any context for the recent pullback.
From over 1,200 down to what, 1060?
Exactly. That raises immediate questions about the rigor of the analysis. It just feels a little incomplete.
I agree. When you leave out the risks, it doesn't make your argument look stronger. It can make it look naive or maybe even biased.
Right. An experienced investor isn't looking for zero risk.
No, they expect to see that the analyst has found the risks and, has built a bridge over them.
It's the difference between just stating your case and actually winning the debate. The analysis sets a target of 1486. That's a massive claim.
40% upside. Yeah, that kind of return expectation demands you address the downside thoroughly.
So what's the fix?
Well, that's why the suggestion here is to introduce a brief, high-impact section. One dedicated not just to identifying the risks, but to immediately mitigating them.
So the risk analysis actually becomes a defensive moat around your thesis.
Precisely.
But how do you do that without undermining the core strong buy message? You want to address the headwinds, but then, pivot right back to the strengths.
You turn the risk discussion into another proof point for the financial fortress.
Okay, give me an example.
For example, you could explicitly name the factors that drove that recent selling pressure, the thing that pushed the stock down to that key support zone of 1050 to 1060.
Was it sector rotation, fear about interest rates?
Right. You articulate the fear. You say, the primary short-term pressure is generalized macro rate uncertainty, or whatever it is, and then you immediately dismiss it.
By saying something like, yes, we see the concern, but BlackRock's diversified AUM and superior cash generation negate that short-term fear.
Exactly that. Or take the bigger, macro risks. Things like regulatory changes on fees or more competition in the ETF space. These are constant threats.
Sure, they're always there for asset managers.
So the analysis needs to address them directly and then explain why BlackRock's fortress, specifically that 0.24 debt-to-equity ratio, positions it to absorb those pressures better than literally anyone else.
That 0.24 debt to equity is so key. It's not just a low number. It means the company is almost entirely self-financed.
Which gives it incredible insulation from rising rates.
And it turns a discussion about regulatory risk into a proof point that BlackRock has the balance sheet to, acquire competitors or launch new products without needing outside cash when the market gets stressed.
It transforms the risk section from a liability into a showcase for strength. If you ignore the risk, the reader supplies their own counterargument in their head.
But if you provide and then refute the counterargument, you control the whole narrative.
And you enhance the perceived expertise of the entire analysis. I think that refinement elevates it significantly.
Okay, so we've established the foundation, and now we've built the defensive moat.
Now, let's talk about the price tag on all this quality. Moving to valuation, which is always, the most scrutinized part of any analysis like this.
Right.
To fully support the claim that the 27.60 price-to-earnings ratio is warranted, the analysis needs to establish a clearer comparative context for BlackRock's premium valuation.
The analysis in their Pillar C section does acknowledge the stock is priced for quality at that 27.60 PE.
It does, but the justification is thin.
It's purely qualitative. It just says the premium is warranted for the world's largest asset manager. And, company size alone is not sufficient proof.
It's definitely not. Not for an analysis trying to convince experts of intrinsic value above 1350.
Yeah, because if a reader looks at the asset management sector and sees an average PE of, say, 18 or 20,
They immediately ask why BlackRock deserves almost 8 extra points of premium. The burden of proof is very high when you argue a premium multiple is justified.
so instead of just saying quality costs more, we need to prove that the specific cost of that quality is acceptable relative to the growth it delivers.
Exactly. We need to integrate specific comparative metrics or maybe historical context into that valuation section.
To really solidify the argument that BLK deserves this high multiple.
We need to answer the question everyone is thinking. Is this 27.6 PE really expensive? Or is it just the price of admission for a truly elite growth company?
So what are the most powerful metrics to use here, given the data that's already in the report?
Well, the material already gives us the gold standard, the forecast of 15.5% revenue growth.
Okay.
The most direct and actionable way to strengthen this section is to calculate the growth-adjusted PE, the PEG ratio.
Ah, yes, because when a company is growing revenue by over 15%, the raw PE ratio can be a really misleading indicator of value.
It absolutely can be. And by using the PEG ratio, you're directly leveraging the growth forecast that's already in the material.
Which gives the whole analysis a really nice internal consistency.
It does. I mean, for anyone listening who doesn't use it daily, it's just the PE divided by the expected annual earnings growth percentage.
And if the number you get is close to 1 or even below 1.5, it suggests the stock is actually cheap relative to its growth.
Right. By calculating the PEG for BlackRock using that 15.5% growth, the analyst can show that paying 27.6 times earnings is actually quite reasonable, especially compared to the broader market index, which often trades at a higher PEG with lower growth.
That completely transforms the valuation point. It goes from a subjective statement, it's the biggest, so it's worth more, to a hard objective calculation. Like, you could say the S&P 500 trades at 20 times earnings, but if its long-term growth is only, say, 8%, its PEG is 2.5.
And if BlackRock's PEG comes out significantly lower than that, it proves the premium PE is justified by superior growth.
It grounds the high PE in a powerful growth context. It's a direct, data-driven counter to anyone who just calls the stock expensive.
And it makes that case for value above 1350 much more concrete. You're paying for growth, not just assets.
That's a huge upgrade. Okay, let's move to our third major area. This one is about timing, causality, and actionability.
Okay.
Right now, the connection between BlackRock's proven financial efficiency and the specific timing of the mid-January 2026 earnings catalyst needs a tighter, more deterministic narrative.
I see what you mean. The report does a great job laying out the financial pillars, all that free cash flow.
But then the timing section feels like they told us the train leaves at 9 a.m., but didn't say what the train is carrying or why it has to leave right now.
It feels a little disjointed.
Exactly. The report correctly identifies that 1050 to 1060 zone as the strategic accumulation zone. It points to the Q4 earnings as the event to break out toward 1200.
But it doesn't specify what operational success, based on those financials, has to happen in the earnings report to actually be the trigger.
It's just wait for the date. We need to link the deep value to that date through a specific expected corporate action.
We have to give the reader an informed thesis on why that specific earnings call is the trigger. The market doesn't just react to past numbers.
It reacts to expectations of future capital deployment.
Exactly. So the suggestion is to refine the forecasting catalyst section. Clearly connect BlackRock's underlying capital capabilities to a likely event that will be announced or confirmed during that report.
Which makes the timing advice truly actionable because now the reader knows exactly what to listen for on the call.
That's the key. The report has already identified that massive capital availability, that $4.7 billion in free cash flow, as a core strength.
That FCF isn't just sitting there. It's capacity waiting to be deployed.
And we need to predict the strategic deployment.
Is predicting a specific corporate action too speculative, though? Should they predict a specific buyback amount or just the intent to do it?
That's a great point. You don't need to specify the exact dollar amount, but you must specify the mechanism.
Okay.
Increase that blows past forecasts.
And both of those actions directly reinforce the income and growth hybrid thesis that's already in the report.
Yes, a major buyback is a classic earnings catalyst. It cuts the share count, boosts EPS, and signals management confidence all at once.
So by emphasizing that the free cash flow will likely lead to an accelerated buyback?
The analyst transforms the earnings event from a simple date on the calendar into a concrete, expectation-driven investment trigger. The report should tell the reader, Listen for the capital allocation plans, specifically the buyback acceleration. That is the mechanism that will push us toward 1200.
That linkage vastly improves the structural flow of the piece. It shows the reader the flight plan for how the stock gets from 1060 to 1200 right after the report.
And it lets the expert reader truly understand the when and the why, not just the what. If the earnings call delivers on the numbers and confirms that predicted corporate action, the thesis becomes undeniable.
This has been a really powerful series of refinements. The initial analysis was built on a very strong quantitative foundation.